I'm Jeni Browne. Welcome to MFB News. Hope you are keeping very, very well indeed. And that life has been very good to you since we caught up a week ago, which has gone like a flash in the pan, isn't it? The weeks are coming round quicker and quicker at the moment, building up to the highlight of all parents' year, which is the summer holidays. Already looking down the barrel of 2 months off for my son, thinking, what on earth am I going to do with him? Anyway, I digress from what we're here to talk about today, which is mortgages. So what have we got for you this week? We're going to be looking at swap rates, lender pricing changes and lender criteria changes, of which there's been a couple. We're going to be looking at house prices, predictions on base rate going forwards, and we're also going to be looking at some research from Spare Room with regards to landlord sentiment. So first up, swap rates, and actually yet again no real change from the last week or two. So currently 2-year swaps 3.78%, 1 month ago 3.58%, 1 year ago 4.5%. So as before, we're circa 0.2% more expensive on swap rates and therefore lenders' cost of funds than we were 1 month ago, but we are in a much better position than we were 1 year ago. And it's a very similar story again for 5-year fixed rates. So 5-year swaps 3.78%, 1 month ago just over 3.6%, and 1 year ago they were just under 4%. So yet again, month on month, slightly worse off, year on year, slightly better off. So what does this actually mean for mortgage pricing? It means that basically the lender's cost of funds hasn't actually changed. So this means that for those lenders who are thinking about repricing, they're going to be kind of balancing the books, looking at their cost of funds and thinking, well, actually, we've got no sort of change in terms of the cost of the money we bring in to then lend back out to mortgage borrowers. So if we are going to make any rate reductions, it's going to be to the detriment of our profit margins rather than anything else. So this is why we're going to see not a lot of change in terms of lender pricing at the moment. Predictions for swap rates, no big changes expected going forwards actually. Could be seen as a good thing because we're not expecting them to go up, which is obviously very good. But likewise, there's nothing really on the agenda at the moment that we're thinking that it's going to really drop things down. Now, as I've mentioned in previous weeks, obviously we have Donald Trump, doing really interesting work in America at the moment, and it was his tariffs which dropped swap rates down a few weeks ago. So it could be that something suddenly appears which could influence swap rates, but at the moment we're not really expecting any major changes. What does this mean for you as a mortgage borrower if you're thinking about taking a mortgage? What it simply means is that actually if you're waiting for things to change, I have got clients who are waiting for the August base rate meeting. The predictions for the base rate meeting is already priced into swap rates. So actually, even if swap rates did come down, it's not going to make any material difference to swap rates. So that means that actually if you're waiting for August to come and go, even if base rate does come down, you're not going to see any great changes in terms of fixed rates. So essentially, in a very roundabout way, what I've just kind of said is we are where we are and we're not expecting any movement in the next few weeks or months. Okay, lender pricing changes. There haven't really been any. I can't remember a week when I've ever had to say this, but there's been a couple of lenders tweaking their product transfer rates and their further advance rates. But in terms of lenders actually repricing their main product set, no news there this week. And I suppose that's really kind of a reflection of the fact that, as I just mentioned, lenders' cost of funds haven't changed. So unless the lenders willing to take a haircut, on their profit margins, where's the scope for them to drop their rates down? So I think realistically it's going to be very, very quiet on lender pricing changes until we see some kind of material move on swap rates. Now, in terms of lender criteria changes, there's been a couple of lenders who have changed their rental calculation, which means that essentially for those lenders you can borrow more per pound of rental income than you could do previously. Now, this is particularly salient, I suppose, because when interest rates were really, really spiky, so think back to your mini budget times, but also kind of the year after that when rates were kind of much more elevated, we were having real problems with the rental calculations. So people were coming to us and saying, I'm looking to remortgage my property, what can I get at in terms of options, or I'm looking to buy something, I'd like to leverage the property or the gearing as highly as I possibly can. And we were doing the rental calculations, the numbers simply weren't working out for people because the rental calculation is based on the interest rate that you're going to be paying, or a notional interest rate the lender assumes. So things have been very, very sticky for a while in terms of rental calculations. Now, the good news is, as interest rates have started to come down, This has made the rental calculations less onerous, which means people are the numbers are starting to make sense. We've also seen rents go up as well, so the two are meeting in the middle and things are starting to look a lot more comfortable. Now, the way that lenders do the rental calculations, it does vary between lender to lender, and there is a kind of set of guidance notes that sit around how they can do these rental calculations, how far they can kind of push things from our regulators, which is all designed to keep borrowers safe and not overstretching themselves. So this is kind of important. But essentially what will happen is the lender will say, we're going to assume that the mortgage payments are going to be a certain amount of money based on an interest rate, and we need the rent to be a certain percentage over that. So a kind of real example would be, we're going to work on the basis that the mortgage interest payments are 5.5%, irrespective of what you're going to be paying, even if you're paying 5.5%, and we need the rent to be 125 or 145% of that figure. And that's kind of broadly how the rental calculations work. Now, when interest rates were climbing and the lenders were looking at their rental calculation, this is going back, over a year now, and they were saying, well, hang on a minute, we're stressing our rental calculations at say 5%, but we know that actually at the moment interest rates are increasing and borrowers are going to be paying 6-7%. So that doesn't work anymore, because essentially there isn't going to be enough wiggle room in terms of disposable rent to cover rental voids and stuff, because it's all going to be used up on mortgage payments, or even worse, people are going to be in deficit. So they had to amend their rental calculations to kind of make the numbers work and make sure that borrowers weren't overstretching themselves. So as we've seen interest rates start to come down, this has really paved the way for lenders to rethink how they're doing their rental calculations and start to kind of open the market back up. So that's a very, very long kind of backstory, but I think it's really important, because what we've seen in the last couple of days is we've seen the Skipton and the Mortgage Works reduce their rental calculation on at least some of their products. It tends to be 5-year fixed rates where you get more variation in terms of what the lenders are doing. So when someone like the Mortgage Works changes their rental calculations, they're the UK's largest buy-to-let lender, other lenders are going to take notes. This is quite a big deal. So I thought it'd be useful on the back of that to kind of just give you a summary in terms of the borrowing power your rent currently holds. Now, these calculations are really, really complicated. There is so much to go into them. So the things that kind of really influence the calculation that you'll access will be, are you taking a 2 or 3 year fixed rate or a variable product, or are you taking a 5-year fixed rate? Are you borrowing in a limited company or personal names? If you're borrowing in personal names, do you a basic rate or a high rate taxpayer? Are you remortgaging? If you're remortgaging, are you borrowing more than you currently owe or the same amount? Is the property an HMO or a standard property? What's the interest rate you're going to be paying? There's loads and loads of stuff that go into this. There's no kind of like hard and fast rule, but what I've kind of done is just to summarise, is give you the most generous rental calculation on the market at the moment, and also kind of give you a good average. So if you're a personal borrower, so borrowing in your own name and you're borrowing against a standard property, the rental calculation, the most generous rental calculation at the moment is 145% coverage, assuming an interest rate of 4.34%. So another way of kind of reframing that calculation would be, you can borrow 221 times £1 of rental income. So if your rental income is £1,000 a month, you can borrow £221,000 or 75% loan to value, whichever of those figures is lower. So that's the kind of most generous calculation. Is that going to bring you the best rate on the market? No, but what it is going to do is kind of serve a purpose. Now, in terms of better average, so from a more competitive rate, you're looking at 145% coverage, assuming an interest rate of 4.5%, which translates into 184 times monthly rent. So whereas previously you could borrow 221 times your monthly rent, actually a proper, more realistic average is 184 times your monthly rent. So you can see the impact these calculations have. On £1,000 worth of rent, that drops the borrowing down by £40,000. So the numbers can be fairly precarious, let's just say. Looking at limited companies now, so we all know that limited companies often will attract a more generous rental calculation because of the way that limited companies are taxed on rental income versus individuals. So at the moment in the limited company space, your most generous rental calculation will be 125%, assuming an interest rate of 4.49, which gets you 224 times your monthly rent. The average kind of figure is 135 times rent, so 125% coverage, assuming an interest rate of 5.39%. So for those eagle-eyed amongst you, you're going to be saying, well, actually, the difference between limited company and personal isn't that great, actually. And you'd be absolutely right for spotting that. Why is that? So although the lenders are using a better rental calculation, 125% for limited companies, and because the interest rates are more expensive, this kind of knocks things back up. But I think the overarching message here is, actually, the numbers are starting to make a lot more sense. Like I say, a combination of the rental calculations easing down and interest rates also becoming sort of more lower means that actually we're going to meet in the middle and the numbers are going to start to make sense. So if you were thinking about buying a buy-to-let property a year ago, you looked at the maths and you were like, actually, I'm just going to have to put too much money into this to make it worth my while. I don't want to part with that amount of capital. The numbers could now make sense. Likewise, if you were thinking about remortgaging, but you actually couldn't, do check again, because it could be that now actually you can access some really competitive rates. Okay, now for those of you who are watching and waiting to see what base rate is going to do, those of you who are on variable rates and are doing a little rain dance for a reduction in August, you may have seen a headline going around saying that Andrew Bailey, who's the kind of head honcho at the Bank of England, could be cutting rates faster. So that's going to get the headline going. Everyone's going to be thinking, hallelujah, base rate's going to come down even faster. But I just want to dig into that a little bit deeper, because there is some context around that. So essentially, Andrew Bailey told MPs at the Treasury Select Committee last week that the Bank of England may abandon its cautious approach to cut rates if inflation risks falling below 2%. Warning that Brexit, tariffs and labour market weakness could justify more aggressive reductions. And this is the bit that I think kind of didn't probably make the headline. So at the moment, just keep in mind where inflation is and what's going on. It's looking really, really unlikely that inflation is going to fall below 2% anytime soon. It's fantastic to see that the MPC are kind of discussing the what ifs. And obviously they're kind of open to making more bullish cuts to base rate if inflation does kind of really fall. But actually, the reality is that there's no kind of immediate expectation that base rate is going to, inflation is going to fall below 2%. Now, obviously, there's lots of stuff that kind of sit around the edges in terms of inflation. It obviously, in what I just quoted to you, they mentioned in Brexit, tariffs and the labour market. So just to touch on tariffs for a moment, it was reported last week that separately the UK has been temporarily spared from Trump's 50% tariffs. The tariff hike, implemented from Wednesday, with duties remaining at 25%. However, the agreement has yet to be implemented, and Trump has warned that tariffs could rise after the 9th of July. So essentially, we've got a little mini stay of execution. We don't really know what's going to happen. So this is kind of all the really unreliable stuff that's kind of going on in the ether, which is really impacting things. And that's why I think to kind of hear the headline that base rate could come down faster than expected, it's really important that you understand the context behind that comment and know that actually there's a lot going on, a lot of things that influence this, and given the expectation of inflation coming down below 2% is not on the cards anytime soon. That's a kind of long-term kind of comment rather than anything that you can rely on in the coming few months. Right, now, house prices. And I'm going to start this off by saying that I'm going to be referring to an article that I read by a chap called Adam Lawrence, who produces a kind of article every week called Proponomics, and you can find him on LinkedIn. He's absolutely brilliant. He's an economist who has a really great understanding of the market. He's really into the detail of the numbers, and he delivers the numbers in a way which is actually very, very palatable. So I'm by no means an economist, and I read his article with interest every single week. So for those of you who kind of want to get more into this, but just find the whole thing very, very kind of overwhelming, or actually, let's be honest, quite just plain boring, Adam Lawrence could be a guy that would be very, very interesting for you to follow. So the article that I was reading was about UK house prices, and what you may have seen is some headlines saying that the average UK house price has fallen. So this is one of those weeks where Nationwide released a report on Monday, and then Halifax released their report later in the week, and they totally disagreed with each other. So Nationwide said house prices were up 0.5% in May. Halifax was saying they were down by 0.4% in May. So two very, very large institutions delivering very, very different bits of data. Now, in terms of where that leaves us on an annual basis, because it's actually not healthy to kind of just really focus on month by month data, because there can be lots of anomalies that impact things. It's better to look at an annual figure. Nationwide's annual figure is now saying the house prices are up by 3.5% and Halifax is up by 2.5%. So essentially your house is worth between 2.5% and 3.5% than it was 1 year ago as an average across the UK. Obviously, there's going to be a lot of variances by region in there. Now, essentially, Nationwide's take on the stamp duty, stamp come down after the event, is that the market is still healthy enough as mortgage approvals data has held up nicely, and a bit more on that in a moment. Their summary is one that Adam isn't sure that many would agree with if they've had their household and council tax bill increases, but they say unemployment remains low. Earnings are rising at a healthy pace above inflation. That's also worth keeping in mind when you're thinking about the comment about inflation that we were just having. Household balance sheets are strong and borrowing costs are likely to moderate a little if bank rate is lowered further in the coming quarters, as some analysts are expecting. So essentially what we're saying here is that actually, despite the rush to get properties over the line for the stamp duty holiday ending earlier this year, the property market is essentially holding up not bad at all. And the reason they think that is because of the various factors like unemployment being low, wages rising, etc., etc. Now, Adam goes on to say that he's not sure how much of that he agrees with. Earnings are doing well, unemployment is low, but higher vacancies are actually lower as well. So core inflation, and this is what Adam really tracks, because we all know that core inflation is actually the real biggie here, is not great at all, over 4%. Bank rate lowering further in the coming quarters. It's up in the air because the governor, Andrew Bailey, back to him again, in front of the Treasury Committee, told them that the trade uncertainty alongside a loosening labour market means that they want to see cooling pay growth and that the bank would continue to be gradual and careful. If he's not voting hold at this meeting, Adam's going to be incredibly surprised. So in short, what Adam's really getting at there is that actually he is not convinced that we're going to see base rate come down particularly quickly over the coming quarters because of all of those reasons we just talked about. So actually, therefore, that would therefore have an impact on what's going to happen with house prices, because mortgage rates won't come down as quickly. Therefore, people that may be thinking about buying are going to be kind of holding back. What does this mean if you're thinking about buying a house? I mean, as we've talked about in previous episodes, it is actually incredibly hard to sell a property at the moment. I've got so many clients, and I include myself in this, who are trying to sell property who are just saying, you know, I'm not even getting a sniff of a buyer right now. Why is that? I mean, you can read into this whatever you like, but my kind of interpretation would be that actually, if you're a person who's looking to buy a property and you're looking at paying an interest rate of, let's say, 4% on a residential at the moment, but you're thinking that actually rates may be down by sort of like 3.5, 3.25 by the end of this year, 0.75% of an interest rate on a mortgage of, let's say, £150,000, that's huge amounts of money that people stand to save by simply waiting. So I think that's what's really holding back the market as much as some of the other stuff we've talked about. So there you go, some interesting takes on what's happening with house prices. I've got quite a few clients at the moment who are sort of saying, actually, I actually think now is a really good time to buy. You may not sit in that camp, I don't know, but their justification is actually house prices are still increasing, as we've mentioned, 2.5 to 3.5%. Interest rates, the speed is up for debate, but the reality is that interest rates are going to ease down over the coming months and years. Therefore, actually, now is as good a time as any to sneak in quick before house prices really start to gain momentum in an upward direction. Now, there's been a bit of research released from Spare Room. So Spare Room are a online company who essentially are a place where you can go to advertise room to let. So this really leans into the HMO market particularly. It could also be that actually you want to rent a room out in your own home, take on a sort of lodger type arrangement. But Spare Room is a really, really good place for HMO landlords to advertise their properties if they're literally just doing isolated tenants coming into a property and people are all kind of unfamiliar with each other, not like, say, a student there where you get a bunch of, say 6 students that all come together and want to take the property on in one hit. So Spare Room have done some research and they released the results this week, and they surveyed around 1,000 landlords, so not a small data set by any stretch of the imagination. And this research was carried out in May, so very, very recent as well. And this has shown a modest reduction in plans to sell, which obviously I love because I don't want landlords leaving the market, because I think you're all fabulous. So in February 2025, 67% of landlords said they plan to either leave the PRS altogether or reduce their property portfolio size or move into a different kind of element of the market. So for example, short-term or holiday lets. However, when Spare Room repeated the survey in May, this figure had reduced to 57%, so reduced by essentially 10%. The survey also said that landlord confidence had increased slightly. So in February, 88% of landlords had no confidence in the market. This has now fallen to 76%. Now, there's no escaping the fact that if 76% of landlords who responded to the survey have no confidence in the market, that's still not a good position to be in. But actually, it's quite interesting to see a sort of softening in terms of landlords looking to divest, and also their confidence levels improving slightly. So what's driving this? It could be that actually people are kind of just adjusting to where we are at the moment. You know, I think when we hear news about new legislation coming in, if there's tax changes, all that kind of stuff, people's initial reaction is always to kind of think, oh, I don't like this. It makes me feel very uncomfortable, absolutely understandably. But actually, as time's kind of ticking on, I think there is an element of kind of people just accepting the situation and figuring out how they're going to work around things. So the kind of parting comment on this article was that stepping back from it all, it still paints low morale among landlords who list properties on Spare Room. And if it feeds through into more landlords selling up, it cannot be good for tenants. Absolutely hallelujah to that. The more of you that leave the market, the ultimate people that will suffer are the tenants, which is ironic given that apparently all this stuff that's really putting off people being landlords in the first place is designed to protect exactly those people. And that is us done for yet another week. Thank you so much for having a watch or listen. Do appreciate it. And if you have any questions or comments or things you'd like us to talk about, actually, just leave us a comment in the note below, or you can email in, you can give us a ring, you can send your favourite carrier pigeon, whatever it is. We're always very happy to have a chat and see if we can help, receive feedback, all that kind of wonderful stuff. So thank you again for joining us, and I shall look forward to seeing you same time next week.